Roth conversion is often presented as a simple idea. Pay taxes now, avoid taxes later. That is incomplete. A Roth conversion does not reduce taxes by default. It shifts when you pay them. The outcome depends entirely on timing. Done correctly, it improves long-term efficiency. Done incorrectly, it increases taxes without adding value. 1. Start with the core question. Why are you converting? Before converting anything, define the objective. A Roth conversion only makes sense if it improves one of the following: reduces future tax brackets, lowers required minimum distributions, RMDs, increases tax flexibility in retirement. If none of these are clearly defined, the conversion is not strategic, it is reactive. 2. Identify your conversion window. Timing drives the outcome. The most efficient time to convert is when your taxable income is lower. For many federal employees, this occurs after retirement, before Social Security begins. During this phase, pension may be active, but Social Security has not started. Total income is lower than later years. This creates a controlled tax environment. What to do? Estimate your income in early retirement. Identify your current tax bracket. Determine how much room exists before the next bracket. This defines your conversion capacity. 3. Use tax brackets as your limit, not your balance. The most common mistake is converting based on account size. The correct approach is convert based on tax bracket thresholds. Example: if you are in the 12% bracket, convert only up to the top of that bracket. Avoid crossing into 22% unnecessarily. What to do? Set a target tax bracket. Convert only within that range each year. Repeat gradually over multiple years. This turns conversion into a controlled process, not a one-time event. 4. Avoid income stacking. The hidden risk. Roth conversion increases taxable income in the year it is done, if combined with pension income, Social Security. Other withdrawals. It can create income stacking. This leads to higher tax brackets, increased taxation of Social Security, potential Medicare, premium increases, IRMAA. What to do? Map all income sources before converting. Avoid overlapping high-income years. Prioritize conversions before Social Security begins. Evaluate long-term trade-off, not just today's tax. A Roth conversion requires paying taxes today. The benefit comes later. The decision should compare tax rate today versus expected tax rate in the future. Conversion is efficient when current tax rate is lower than future expected rate. RMD exposure is high. Long retirement horizon exists. Conversion is inefficient when current income is already high. Retirement tax rate is expected to be lower. Conversion pushes you into a higher bracket. 6. Structure conversion as a multi-year strategy. Roth conversion should not be done all at once. It should be planned across multiple years. This allows better tax control, reduced bracket jumps, more predictable outcomes. What to do? Create a 3-7-year conversion plan. Adjust annually based on income changes. Monitor tax bracket thresholds each year. Conversion efficiency is determined by timing, not amount. Roth conversion is not about how much you convert. It is about when and how you convert. The correct strategy uses low-income years, stays within tax brackets, coordinates with other income sources. When done correctly, it reduces long-term tax exposure. When done without structure, it creates unnecessary tax liability. The difference is not the tool, it is the execution.